Now, after understanding the different candlestick patterns, we need to be aware of the market structure. That is the most important thing. So, as all of you are aware, so there is no single system that is going to work in every single market condition. And there comes the importance of identifying what market structure we are experiencing at the present point of time. So, let's study how we could actually look at the market structure, and I will also brief you about the three major market structures that we observe. Broadly, we can classify the markets to be a trending market condition, a ranging market condition, and a choppy market condition. In simple words, a trending market condition is one where the price is keeping on traveling in a single direction. So, it could be either in the upside or in the downside. Whereas, in the case of a ranging market condition, so we will be seeing that the price is actually kind of bouncing between two different levels in a simultaneous manner without traveling out of the range. Now, if you ask me, then how do you define a choppy market? So, a market condition where you are not able to differentiate whether it is trending or ranging is generally what we refer to as a choppy market condition. So, such markets are not at all suitable for trading, and as far as an individual is concerned, it is going to be difficult to identify whether we are in a choppy market also. Howsoever, as we move forward, we will show you cases or case scenarios where we could actually look into some factors that will help conclude what kind of a markets we are looking into. First of all, let's study what a typical uptrend is. So, this is one of the subclassification of a trending markets. As I mentioned, markets could be trending either on the upside or even on the downside. Now, when we speak about an upside trending market, it is nothing else but a combination of highs and lows. So, when I say highs and lows, first we see the prices forming a high, followed by that it made a low. Then again at a later point of time, the price is once again making a high and a low. So, this pattern keeps on repeated in a uniform manner. So, in simple words, always the highs that is getting formed is higher compared to the previous high that got formed, and every low that is getting formed is always higher as compared to the previous low that gets formed. So, we could simply classify a typical uptrend as a combination of highs and lows that is getting formed, and every consecutive high should be higher as compared to the previous high, and every consecutive low that is getting formed should be higher as compared to the previous low. So, if these conditions are being satisfied, we generalize that the trend is up. Now, let's talk about a typical downtrend. So, as you know, a bearish trend or a downtrend is one where the price is continuously forming lows. In this particular case, we see first a low gets formed, then again a high price gets formed, then again a low gets formed, and again a high price gets formed. Now, what is very important out here is every single time the lows are getting formed, it is always lower as compared to the previous low that got formed earlier. And every single time the next consecutive high is getting formed, the high is always lower as compared to the previous high that got formed. So, in simple words, a typical downtrend is nothing else but a combination of lower lows and lower highs. And if this pattern is continuing, we say, yeah, we are experiencing a typical downtrend. Now, we have spoke about the trending markets. Now, the other major markets that we often see is what we refer to as a ranging markets. Now, what happens over here is rather than having a fixed direction, the price keeps fluctuating between two levels, and we specifically call these levels as the resistance and the support. Now, a phase of time when the market is traveling bound these intervals is what we refer to as a ranging market conditions or a sideways market. We also have the third market condition that we refer to as a choppy market. Now, let's have a look at the choppy markets. Now, the third kind of markets is what we refer to as the choppy markets condition. Now, what distinguishes this particular market condition from the other two is the fact that we really don't have any idea about the direction or any idea about the range in these kind of markets. Now, it is not at all so easy to identify these kind of markets. In fact, it would actually cause us some sort of losses also, these kind of markets. Howsoever, I just wanted to convey to you, so majorly 70% of the times we find that our markets are ranging in nature, and about 30% of the times we find that our markets are in a trending condition. Now, let's understand how or what all opportunities we can utilize in the different market conditions.